All right, it turned over to 12, so I'd like to welcome all of you. Thank you very much. Beautiful Wednesday here in East Texas. It thinks it's summertime. Look out my window and everything's budding, so I hope we don't get a hard freeze. That would not be good, but it's very just been beautiful the last few days. Well, again, thanks for joining us. We're recording this as I've said before, and I welcome you to send a chat or to make a comment at any time. I love it when things are more interactive. So today I'm just going to kind of give an intro into capital gains and losses. There's some questions we field a lot about this, and it's a complicated area actually. And in some ways, maybe I'm making it too simple, but I think we'll get some concepts across here that hopefully are helpful. Let me get to my SharePoint. Sorry, I may have to go away from this for a second. Where did my SharePoint go? Should be able to advance this screen. There we go. The agenda today will talk a little bit about what capital assets are versus non-capital assets, what the importance of holding periods, what the capital gains rates are, how they differ from ordinary tax rates. How do you calculate basis? That's an important question to answer because you pay tax on the difference between the net selling price and basis, the gain. Introduction to like-kind exchanges, which is a way to kick the can down the road. So give some key rules there. And then Q&A. And like I said, anytime anyone wants to jump in, feel free. Well, the long-term capital gains rates are very beneficial, and they're based on your taxable rate, your taxable income. And it's not easy. The calculations, and I'm so glad we use computers because it's a very different calculation because when a tax return has capital gains, part of that return is taxed at ordinary rates, part of it is taxed at capital gains rates. But if you look at these limits, these do include the capital gains to get to these levels. But you can see capital gains can actually be zero. I mean, if it's a small gain, and maybe perhaps for a retired person or a young person starting out, and the taxable income isn't very high, you can actually pay zero on a capital gain. So then the next rate is 15, and then there's 20. It's a little bit deceptive too, because there's this 3.8 investment tax. It's been around, I think, since 2013. It was introduced. And that's another calculation that's not as straightforward, but I always tell people just think about setting aside 24% of a capital gain for taxes. And that would include both these taxes. So again, you get kicked into the next rate if your taxable income and your filing merit is over 94 and some change. And then the 20% if it's over, a pretty healthy amount this year. But a lot of times if people have had a building for a long time or had some land for a long time and they have other earnings, it's not hard to get kicked up into that 20% rate. Okay. Anyway, the reason that capital gains are so important is, as you can see, I'll try and multitask and talk while I go find out what's going on here. Is because ordinary income rates go well up almost to 40%, and if you take into account state taxes, in some cases it's much higher. So obviously you would want to have favorable capital gains rates on a transaction, and that's where we're going to get pretty quick if I can climb back to what I need to climb back to fix my PowerPoint and stay on task. So it's important to know what is a capital asset versus what is what is an ordinary or non-capital asset. And when you sell a non-capital asset, I think I may just leave it like this and not do the slideshow just so I make sure this doesn't happen again. So let me share this this screen. So thanks for your patience on this. Little glitch. Okay, so I'm not sure what happened there, but the magic number for getting something beyond, again, if we go back and we talk about to be able to qualify for these rates, you have to hold an asset for over a year. This is a little tricky in that it is from the date you place something in service. So technically, depreciation starts not when you buy an asset, but when you place it in service. So sometimes we've had people literally buy an airplane on December 28th and make sure they took a flight the next day so that it can be placed in service back when the bonus depreciation on that was so huge. You get a get a big Caterpillar on the 30th. Make sure you're using it in business on the 31st. So it's from the in service date. But that's a very I've had people that have been very frustrated. They come in and they didn't realize this, and they could have waited 2 weeks to close and paid much less tax. So pay attention to the holding period. Less than 1 year, ordinary income rates. Over 1 year, capital gains rates. Okay, what assets qualify for long-term capital gains rates? And capital assets are broken down in basically tangible and intangible. You can see that, okay? Well, I just don't want to mess with this since can everybody see that okay? I guess you could give me feedback if you can't see it. Uh, anyway, so capital assets are basically long-term assets. So we could say, well, a stapler. I've always thought about this. Technically, the rules are anything with a useful life of longer than a year should be capitalized and depreciated. So technically, you should depreciate this stapler over 7 years. But as a practical matter, companies always set capitalization rules where for most of our clients, we say if it's less than $1,000, just kiss it off, put it to supplies, put it to tools or whatever. It's just not practical to keep depreciation schedules. So the IRS is fine with setting these capitalization limits on different things, and it could be different for maybe you say in a larger company, you might say over several $1,000s, computer equipment over 1,500. The rest of it we just sort of treat as supplies because of the materiality there. But anyway, they are when they're capitalized and depreciated, they become capital assets. So that's property, plant, equipment, furniture, anything that goes in a building. Um, can be the improvements. It can be leasehold improvements if you're renting stuff property. It can be landscaping improvements, sidewalks. Anything that's sort of tangible in that way. And it can be fine art, and technically it can be your car. I mean, your personal vehicle. And if you sell your personal vehicle for a gain, the technical rules are you're supposed to do that as a capital gain. Most people, if they don't use it in business, it doesn't ever get reported. But fine art would be something there. A tangible gold and silver that aren't collectibles. By the way, there is a different capital gains rate for collectibles, and it's 28%. I believe, at least it was, but it is a capital gain, but it's a little higher if it's a collectible. Your personal residence is a capital asset. And for a lot of people, that becomes a reportable event because if you're single, you can exclude up to 250,000 of gain. If you're married, it's a 500,000. As long as you've lived in that house 2 of the last 5 years and you haven't used the exclusion in that time period. So there's a big break for selling a personal residence. But this also includes intangible assets, the piece of paper that is a stock or a bond or purchased business goodwill, which is the going concern value, the client lists, the knowledge and all that. So when you buy a company and there's an amount assigned to that, that's an intangible asset. Non-capital assets, if you sell these, they're going to be treated as ordinary income or loss, cash, accounts receivable, inventory for resale, and supplies, things like that. So basically, the definition is everything that's depreciated with a long value, or even personal things you own that you wouldn't depreciate that are not in business, but they're have a useful life of over a year and a material amount are considered a capital asset. So, what is taxed? And I had animations on these things, but you're not getting your full money's worth. The tax is the net selling price minus the basis, and we'll talk about how to get to basis. So the net selling price is, if you sold a home or a business building, there's the gross sales price, $475,000, and then there's the commissions and all the closing costs. those get to come off. So you can deduct those from the selling price. You take that minus the basis, and that is your long-term gain or loss. Now, it's important to realize that amortization and depreciation. So, if you've got a business asset, over the life of that asset, you're depreciating it. So its basis goes down as you depreciate it. You may have bought it for 300,000, but over 20 years you depreciate it. It's only on the books at 100 or 50, whatever. And if you sell that for a gain, there's going to be a portion of that depreciation that gets recaptured at ordinary income rates, especially for equipment. So because you got to write that off against ordinary income, the depreciation comes off that way. The logic is now you got to recapture some of that at ordinary income rate. So projecting these can be a little tricky sometimes, but it's basically the net gain or loss. Now I will mention, I don't have a slide on this, but capital losses can be offset dollar for dollar against capital gains. But capital losses can only be offset against ordinary income to the tune of $3,000 a year, basically for joint return. So if you had a $100,000 loss on something and no other capital transactions, you can only take 3,000 of that off on your tax return in the year of loss. But it carries forward. It carries forward until you can use it. So you can apply that 3,000 a year ad infinitum if it's a big loss, or until you finally sell a capital asset, boom, you get to use whatever the balance of that capital loss is. So they are valuable. It isn't as helpful in the year of loss if you don't have other capital gains to offset it. And so that's why people talk about, if you're looking at a portfolio at the end of the year and you've had a significant number of capital gains through the year, the advisors are going to tell you, look, we have some bad choices in here and they're not going to get better. Let's go ahead and sell them so we can offset against that gain and lower our tax. Now, it isn't, again, it's when the sale occurs. If you have a stock that went to zero, it doesn't matter. You have to actually make a transaction to sell it and to get rid of it. And then you've got a loss you can offset against other gains. So I just wanted to insert that about losses. They are limited, but still useful to offset capital gains. Now, basis is tricky. Basis is tricky. In general, basis equals what you buy for something, plus the buying expenses, and that could be putting it in service or the buying costs, the settlement charges to a buyer, plus improvements you make over the years. And these are, again, improvements that you don't expense. You can't write off something as a repair on year 4 and then remember, oh yeah, I put that new roof on a long time ago, and suddenly call that an improvement against basis. These would be improvements you capitalize or begin to depreciate on a tax return. Then less amortization and depreciation allowable. Amortization and depreciation are really the same thing. Amortization just applies to intangible assets like goodwill, and depreciation applies to hard tangible assets. So anyway, you have cost plus buying expenses plus improvements, but then that goes down over the years as it's depreciated. But the thing to remember, and we're not going to get into this today, but there are very different rules for capital assets that are acquired by gift and by inheritance and by exchange. And I'll just say very quickly, in a general sense, these things are complicated, and we always have to look at individual things. In a general sense, when you acquire something by gift during lifetime, you have the basis of the giver transferred to you. And that is significant because we have some clients that for various reasons will transfer real property to their heirs before they pass on. And that means that the starting date and the basis, they may have bought that at 1948 for $5,000 and it's now worth $1 million. 5,000 is still that basis that gets transferred with that gift during lifetime. The difference is, for most things, if you inherit them after the date of death, they get a step up in value, and the basis becomes fair market value at the date of death. And that significantly changes the picture in terms of the gain or loss when the heirs sell an asset that's been inherited versus one that was received by gift. So that's just a quick thing there. And then by exchange, we'll talk about that in just a second. There are difficult calculations for basis if you own partnership interests and S corp shares and other things like that. Basis for some investments can be complicated, so it just goes beyond the scope here. But again, those sometimes you need help, and we can do that to calculate those. So basis can be tricky, but that is an important number. And what that means too is that you end up having to sort of, we normally tell people keep things for 5 years. The statute of limitations is 3 years after the date of filing a tax return. If you keep stuff for 5 years, you should be in good shape. Some of the stuff that has to do with basis, though, you should probably hang on to for as long as you own a large capital asset. Okay. I don't know if we have any questions. I can't really see the chat from here. We'll get to that in a second, I guess, or yell out if you want to. Okay, so that's we've had some clients we've talked to about we look at a capital gain projection, and let's just think about it. If you had a $1 million gain on a piece of property that's been in your family for a very long time, you could be paying over $250,000 in tax on that, and that's a significant amount of money. So there is a way to kick the can down the road with a Section 1031 like-kind exchange. And this is only for real property. It used to be for equipment and other things, but it's now just for real property. What that means, though, is it could be farmland for an apartment building. It could be an apartment building for, duplexes. It could be a rent house for raw land. It's just real property to real property. But there are some things to bear in mind about this. And again, it can be quite complex, and we've helped numerous clients do this, but you always go through an intermediary to handle the transaction. You can't touch the cash. So the way to make a 1031 work is that you acquire one or more properties of equal or greater value to the net selling price of what you're trading or selling. So you're going to sell this property for $800,000. You need to find net after selling expenses. You need to find one, two, or three properties that are worth $800,000 to make this exchange work, to kick the can down the road. You have to use an intermediary. You cannot touch the money. I've had people come in after they sold something. Hey, I want to do a 1031. No, you can't touch the money. I mean, this all has to be planned out and taken care of in advance. There's some really important deadlines. You have 45 days before and after the date of closing on a property to identify three possible replacement properties. You can do more, but it's just easy to do three. So I'm just leaving it at that. So you scout it out and you say, yeah, I think I'd like to acquire this and acquire that and acquire this other one. Those are possibilities, and they will get me over the deal. I'm just going to add very quickly, this is complex. If you've got a mortgage on one property, you really want to have a mortgage on the other property about the same value, of the same amount. It gets tricky on some of those things. You're acquiring a property for investment or business purposes, so that means you're not going to flip it in 3 months. Typically, the advice I've heard is you should probably plan on holding that new property for a year. There's no hard and fast rule to that, but that sort of makes it clear that you got it for business or investment purposes. So you have 45 days. That's a really important number, and you have to formally reach out to the intermediary, and they have forms they give you, and they don't charge much, a few $1,000 for handling all this paperwork. So what happens is the money goes to them, and then you identify the properties. You have 180 days to close. They will take the proceeds from that, and they will use it to acquire the new property and then title it to you. So it goes through the intermediary, ends up to you. So you traded one property for the other. But the trick is that the basis of the old property becomes the basis of the new property. So if you sell the new property, you are going to have about the same gain, maybe more, but it kicks the can down the road. And in fact, if you keep kicking the can down the road until you kick the bucket, your heirs could get a step up in basis, and there would never be this tax paid. So the tax is deferred and kicked on down the road. So let me. We'll go to Q&A, and I will stop my share. And if you guys have any questions, please fire away. Don't see any chats. So
Hey, Steve, it's Carrie.
hey, Carrie, good to see
How you
you.
doing? You too. Got confused here on the beginning. I have a new computer and it wasn't bringing it up, so I had to go to my phone. Quick question. Okay, a small cash investment with the potential to return, let's say 10 times within a year.
Uh-huh.
Okay, so at that point you pay the person who's putting the deal together, and then out of proceeds. And then if it's within a year, you're going to pay full capital gains tax. Is that how I understand it?
Well, full ordinary rates. So it just depends on, where you end up in the tax bracket, 10, 12, 22, 35, whatever. It's just gonna, you won't get to enjoy the benefit of the long-term capital gains rates. I'm kind of glad you said this though, because, I've also had some clients who have, sometimes I say, look, you may be better off selling and eating the tax, because if you really feel it's at its peak, you may leave money on the table, not doing the transaction, trying to wait for the year to pass. So it just has to be, Carrie, you would want to take into account, am I going to lose money if this wait goes over a year?
Well, that's the other question. If it does go over a year, what's the rate at that point?
Well, again, if you go back, let me, I'll pull this other slide up and share this again, and show you so these are the rates based on your other earnings. It could be zero if your total income, including the gain from the investment, are under 94,000, or 15% in this range, or 20%. So again, those are way more favorable than the regular tax rates. I don't know what you are. You're probably talking what, 35, 37, something in here. I don't have the tables memorized. But those are the favorable rates. So you kind of just have to do the math.
Put the thing of water in there.
Oh, I'm sorry. Somebody else have a question? I couldn't hear that.
Just to follow up. Oh, there they are.
I don't know. So yeah, go ahead, Carrie.
Yeah. So follow up. Then the investment was made, let's say in March.
Right.
Money changed hands in March, went to the entity that's working with the actual investment side of it. Then they don't invest until May. Do I get to start with March for an entire year to pass that year, or do I have to start when they actually invest the funds?
Oh, okay. So sorry. Say that again. So in other words, you invested part in March and all through May.
Well, no. It was held in an account from March through May. That thing was actually done with the investment. It actually came about in May. So do I have to go May to May for that year, or is it March to March?
Yeah, I mean, we might have to look at that one. We might have to look at the paperwork on that one, because if you made the payment into the investment that's going to return it, I mean, you don't control what they do with the money in the meantime.
Right.
But
That's what I was hoping.
yeah, but yeah, so you may want to shoot it to me and upload it, or shoot it to me in an email, and I could look at that a little better.
Okay.
I'm answering that question like every attorney answers every question. It depends on the facts and circumstances of the case at hand. Anybody else have a question? Well, okay. That was that. I try and keep these short and sweet. So appreciate everybody taking some time out, and again, love feedback. Sorry about the slide mess up. And if you have any topics you want, shoot me an email or whatever. Hope
Thanks,
everybody
Dave.
has a
Appreciate it.
blessed rest of the week.